What are municipal bonds? Municipal bonds are certificates of indebtedness issued by states, cities, or other local governments to raise funds. Traders and investors have nicknamed them munis. Government entities fund projects such as road repairs, purchase of open land, upgrade of systems, etc. through these bonds. They are naturally attractive because they often come with security and tax benefits. For example, many municipal bonds provide federal tax-exempt interests. Now, how does it work? Municipal bonds are still debt securities issued by these organizations to bondholders. Simply put, the bondholders are lending money to the bond issuer through a loan evidenced by the bond. When the bond maturity date comes, the holders expect to be paid back the face value of the bond. The bond becomes due and payable on the date stated on the bond. The amount of the bond when it was issued is called the face value. It is also known as the par value. To entice investors to lend money through the bonds, the issuers offer to pay interest on those bonds. The federal and state governments usually exempt these interests from federal and state taxes, respectively. The issuer commonly pays the interest every 6 months until the bond's maturity date. By then, the government agency will repay the bondholders the amount of money represented by the bonds. The bonds will usually come with a coupon. Originally, the coupon was a detachable portion of the bond that bondholders used to collect the interest. Now the term coupon is widely used to denote the annual interest rate paid on a bond. The rate is a percentage of the bond's face value. Many investors do not buy an initial issue of the bond at its face value. They usually scan the bond market for municipal bonds that are not selling at par value. The price of the bond is the value of the bond bought and sold at a given period of time. The price of a bond could go also higher or lower than its actual face value. This will depend on several factors, including the state of the economy and market conditions. The price of a bond is expressed using cents on the dollar. For example, if a $10,000 bond were selling for $9,700, its price would be quoted as 97. The bond's yield or yield to maturity, YTM, is important information for investors. It is a calculation of the total interest plus principal that would accrue if the investor keeps it to maturity. It takes into account the amount paid for the bond plus interest until the maturity date. Investors pay more attention to the yield on that interest rate or coupon. Bondholders can see through the YTM how much amount they will get later, so they can make better cash projections. That's it for now. On our website, you can find more posts and podcasts, as well as calculators and other financial tools. Do you consider municipal bonds? We would love to know your thoughts, so feel free to share them in the comments below. I hope you enjoyed it. Don't forget to subscribe to our podcast channel on YouTube. Thank you, and we'll see you next time.